Discord. Let me close Telegram. All right, guys, how's everybody doing tonight on this Monday evening? Drop it in the chat how everybody is feeling tonight. So you're doing, somebody's like, I am Alessia Verani. I was like, great. What's up, y'all? Drop it in the chat how everybody is feeling tonight. Let me see responses from every single person in this room. Thank you, Montana. Thank you, Shani. Thank you, Tootsie. Let's go, let's go, let's go. All right, perfect. Fuego, that's what I like to see. So before we get into the actual training regarding trading, I do want to start off this session, as always, with a little bit of psychology. As you know, this is the third week of our Traders Bootcamp, our second to last week of the Traders Bootcamp. And one of the main reasons why I start each session with a little bit of mindset and psychology is because you heard it the first week from me, you heard it from Millie last week. A lot of trading is literally emotional discipline and just discipline, period. So all that to say is, for the ones that submitted your homework, thank you for submitting your homework, especially by the deadline. It made it easier for me to review your charts, and I have specific feedback for every single person, which I'll get back to every person who submitted their homework with that specific feedback. Now, a few things in regards to the homework, and this isn't me like calling anybody out or cracking the whip and trying to make anybody seem less than, but for those of you that didn't do the homework or didn't do it by the deadline that it was provided, a question to ask yourself is why? You know, one of the things that I've seen within trading in general, especially within this platform, is we all have the same access. We all have the same access to the same information. You know, granted, some of us have a little bit of a personal connection, certain educators, but for the most part, we all have the same access to the same information. Yet, one of the main reasons, and this is a conversation that I had with some of the educators, why people are not successful to the capacity that they want to be successful, is literally because they don't do the work, or they don't do the work as instructed or as provided or as given. So that is just something for those of you that didn't do the homework or didn't do it by the deadline, like what showed up for you. Second thing, in reviewing the homework, I need to triple check this, but I'm pretty sure there was only one person who did the homework in full, which was list if there's more buy candles or sell candles based on the currency strength meter, meaning if the first pair is stronger, would you see more buy candles? If the first pair is weaker, would you see more sell candles? I have to double check that. I'm pretty sure there was one person, maybe two people, that included that in their submission, with also marking up their support and resistance. So into the first point, and I say this because I want everybody on this call to be successful, is to not just pay attention to the trading session, but pay attention as to how you're doing certain things. Pay attention as to what are the things that you don't pay attention to. Pay attention to what it's like to learn information, and seeing what are the things that you're not naturally picking up. Because what you're not naturally picking up and therefore not implementing is probably, or are probably, the things that are roadblocks towards your success. Now, on that note, I am going to award, and I didn't say this last week because I didn't want to make it a thing. I didn't want to make an incentive the reason why somebody would go above and beyond, but I'm going to do a private trading session with the person who I feel did the homework to the best of their capability. And this person actually had to borrow a laptop. She had to use her cell phone's hotspot to get Wi-Fi, to get on the markets, to do the homework. And this person's all the way out in Italy. She's up right now. It's like, I think like 4 or 5 in the morning, and she's making a sacrifice to be on this live session. And that is Miss Alessia. So if you are listening to this, just please also look at her chart for reference, but please drop it in the chat, a few fire emojis, some 111s, because she literally went above and beyond not just in doing the homework, but she made no excuses about it. She borrowed a laptop. She got on a hotspot. She's up right now at 5 in the morning. And it's just so beautiful to see that level of dedication. So Alessia, I'm gonna follow up with you for a private trading training session. So on that note, I'm gonna go ahead and share my screen. And tonight's topic of conversation is going to be support and resistance and trend lines in detail. So let me just load up a fresh chart. And I'm gonna use a different broker that I know I've never used, just for the purposes of teaching this. So let's see, and let me just load up a different layout. Which one is this one? Oh, this is great. There's nothing on here. So we're gonna be looking at Euro USD. And I'm gonna walk you through the way I personally mark up my charts. And this is the way I utilize my chart markups for both FRX and HFX. So last week, the homework was to briefly just mark up consolidation and mark up trends, right? So getting into really specifics of the market is tonight's focus. So because this bootcamp is geared towards both trading styles, I'm going to be starting on the monthly. Now, even if you trade HFX, which it would be very rare that you would ever use anything higher than the 15-minute chart, it is still a good idea to even go to the 4-hour or 1-hour chart. Reason being because the 4-hour is really a good indicator as to where the market is going to go for most of the trades that we will take. So as first nugget number one is the 4-hour gives you a good indication where the market or the market's direction is headed, meaning if it's going up or if it's going down. That is the first thing to notice, that the 4-hour gives you a good indication as to where the market will be going. Now, the 1-hour is great for your setup, meaning your setup is your trade ready. Is the market ready for a sell or for a buy? So the 1-hour, especially for my FRX people, is really great to understand what is the type of trade that you could be potentially taking. Now, the 15 and 30-minute are good entry zones, especially for FRX. So usually for FRX, you would enter on the 30-minute or 5-minute, or 15-minute. Now, as you guys know, if you've been on my sessions, I use an additional version of the super sauce strategy that allows me to enter the market based off the 5-minute. So depending as to either your strategy or how you look at the market, you could also potentially enter an FRX trade off the 5-minute chart, giving you probably one of the earliest entry points for a longer term trade. Now, the reason that I am saying this, and this is also for my HFX people, is that although we look for the overall direction, the overall move on the largest time frames, reversals, market changes, consolidations start on the 1-minute. So even though we kind of work our way down, what happens on the 1-minute over time will affect the rest of the higher time frames. So sometimes it is very critical to understand from a top-down analysis perspective, meaning you start on the monthly, the weekly, the daily, the 4-hour, the 1-hour, 30-minute, 15-minute, 5-minute, 1-minute chart, to understand that maybe, just maybe, the fake out or the reversal on the 1-minute isn't so much a fake out, but is the beginning of a full-blown directional change. So that's why it's very important in general to do a full top-down analysis. So now getting into marking up our charts. So I always recommend switching from candles or Heikin-Ashi candles to the line graph. The line graph shows you where price closes for that candle. So really, really quickly, we switched over to the line graph, which eliminates the wicks. It eliminates a lot of the confusion. So what you're seeing on here is price closed here, price closed here, price closed here, it closed here, it closed here. There's no wicks, there's no confusion. So when I switch over to candles or Heikin-Ashi candles, then I get to see the strongest levels for my support and my resistance, right? So when I mark up my charts, the first thing that I always ask myself is, where does price have a strong reaction? Where does price have a strong reaction, right? We see over here. And I always recommend labeling your levels, because if you're trading off a smaller time frame, realistically, for the most part, there are exceptions, but realistically, a smaller time frame move is more than likely to respect a trend or a support or resistance level from a higher time frame. So I always label them for that reason only. So now let's see, where else do we see a strong reaction, right? We see it over here. My strong reaction is, it is very apparent that price did not like to be over here, so then it dropped all the way down, right? And we see it over here. Boom. Where else do we see it? We see it. This is going to be like a resistance zone. So there's a school of thought that uses support and resistance zones versus lines, meaning that as opposed to having a singular price level, depending as to how close different peaks are, you may have a support or resistance zone. So what that would look like is, this would be a zone. This would be a resistance zone, right? Personally, I don't utilize zones too often, especially if I am scalping the market, because when I scalp the market, I usually use my 5-minute or 15-minute levels, which are pretty unzone-like. It's not a word, but they're pretty clear as to where they will be, right? So now getting into more levels, right? We see a strong reaction here, and I'm gonna pause right over here for a quick second. Reason being is because we see price reacted over here. Price had a strong reaction over here. It came up and it came down, right? Finally broke through, came up again, came down, but it continued moving up. Then we see it had a little bit of support. This was a little bit of support, this level, for the down move. But once it finally broke through, look at this amazing drop. It just dropped all the way down. From June 2014, for almost a year, prices plummeted down on the Euro USD. So this level over here shows you that this was previously resistance, then it became support. But either way, once it broke through this level, it continued its up move. And then once it broke through it on the downside, it plummeted. So all in all, to say is that these levels are interchangeable. What was previously resistance can then become support. And what was previously support can also then become resistance, right? So moving forward, right? And I'm not gonna spend too much time on the monthly, because I want to get into a few specific things about marking up our charts that most people don't typically cover, right? So what I personally do is, I don't mark up every single swing level. Is I like to just see with clarity a few things. Where does price have the most adverse reaction to? And usually it sees price touch it a few times before it breaks through. So here we see it touch One time, twice, broke down, finally it broke through, and it has not reached its sense, right? So now, getting into the weekly, right? Getting into the weekly. What are we seeing? What we're seeing so far is a pretty good indicator that our levels are pretty solid. So even on the weekly, there's a lot of noise over here. Boom. Let me just zoom in for 1 second. Now, one recommendation is if you're marking up your charts and something may seem a little confusing to you, is you can temporarily switch over to candles or Heikin-Ashi candles, which is my preference, to kind of see what may be the confusion. So for example, what was confusing to me was how far that these levels went, how far this was, but that was due to a wick. So now that I know this, I am more comfortable leaving my level where it's at because it is closer to the body of the candle. Now, the thing about wicks is that wicks are not where you should add your support and resistance to, because wicks are temporary movements. You want to just pay attention primarily to the bodies of the candle. The closing and the opening is usually where price travels. Wicks can be as short-lived as a few seconds, sometimes a few minutes, and depending as to what time frame you're trading, can be a few hours. But in relation to the time frame that you are trading, wicks are very short-lived, right? So now this is our weekly support level on Euro USD, right? So now I'm going to speed up the process because I want to get into our trading zone, right? So by that I mean is on the weekly, the most recent low point is here. The most recent high point with the less noise, meaning the less possible confusion as to where your highest point would be, is here. Because previously to this, we were just on an uptrend and then it reversed. So our trading zone from the weekly, which is where we would look for most of our trades, would be from our most recent highest point, meaning it came up, came down, came up, came down, came up, completed the uptrend, and then it came all the way down. So our most recent high point is right over here. Our most recent highest point, better said, is right over here. And our most recent lowest point before it reversed was over here. So in the weekly, this would be our trading zone, which is where we would look for most of our trades, right? Now, getting into the daily. Now, one thing that I do, depending as to where I'm at within my time frames and how far away, let's say this point is from this line and this point is from this line, is I usually adjust it because this is only about a 60 pip move and wasn't that much of a move. And I believe this is about like not even that many pips, right? So within our trading zone, we want to find more levels because realistically, we would never trade off the daily. Well, I mean, you can unless you want to be a swing trader, but realistically, most of us on this session are scalpers, meaning our trades expire within a day. Scalping is technically defined as anything as little as 1 minute to within the day of you trading. So now finding more additional levels, right? So another good level that I'm seeing roughly right over here, where price returned to it a few times, is here on this daily. Right? Now, another good level roughly, there's a few levels here. That's what I figured. Yes. Boom. See, again, this was the wick where the best level is roughly where this was support and then it became resistance, right? So sometimes I do switch while I'm in the line chart. Why I put the line chart in there. So then when I switch over, I just want to see where the body of the candle is, right? Now, second thing, third level that I see, let me just confirm. Boom. 2. Right, and then we're gonna do a compare and contrast on the super sauce to see what our levels will be calling, right? So now, getting into the 4 hour. Getting into the 4 hour. So now a good question that people have is like understanding where you mark up your resistance, your trend lines. It is preference and it is also very biased, meaning some people do trend lines like this, which is how I personally do it. Some people do multiple trend lines where it'll be like this, and then you have a channel, and then you trade off. You would take this for a buy, and then you would take this for a sell. So depending as to your trading style will affect how you mark up your trend lines. So all that to say is that there's a few things to know when marking up your trend lines properly. So when it comes to marking up your trend lines, for an uptrend, you connect the higher lows. You connect the higher lows. For a downtrend, you connect the lower highs. Now, a few things to know about trend lines and trends in general is that to establish a trend, you need to connect at least 2 points. To confirm a trend, at least 3 points. Additional tips, you want to naturally connect as many points as possible. What that means is you don't force the connection because it may not be a valid trend. So what does that mean? What that means is, like I said, I want to connect for a downtrend my lower highs. Technically, this is the first one. This is the second one, second area. But after that, this is a low point. This is a low point. So this trend isn't confirmed. It's just established. Versus over here, it seems like a much more solid trend line where there's more touches off this level versus this level. So when it comes to establishing your trends, you want to keep in mind how many points are touching your markup. And then you also want to remember you never want to force connecting points. Because if you're forcing connecting points, you may be sabotaging your potential trade idea and therefore lose the trade, right? Now, based off the 4-hour, what we're seeing is that at least for the Euro USD, we are still very much in a downtrend. We are still very much in a downtrend move. So what we want to look for primarily are sells. Now, because we marked up our level on the daily, we can still add additional resistance levels and additional support levels. So me, I would add a level right over here for a few reasons. One, we see the price came up, came down, pulled back up, broke through here, and came all the way down. So because this is the pullback, the price had a very strong reaction. It is very possible that if price reaches this level again, which just so happens to be roughly where the trend line is, we could see a very strong reaction in either capacity. Personally, understanding just market structure within market structure, what we're seeing is that price bounced off. Let me just lock this. Bounced off here, right? Came up, came down, came up again, came down, boom, and is currently on the up and up, which I'll explain what this means later for our newer students. But this may be the end of a mini uptrend within the overall downtrend, meaning that this pullback, because it's on such a large time frame, can go through 3 phases of the uptrend while still respecting the overall direction, which is down. So what I predict will happen is that price will roughly reach this level and then sell off again, thus validating our downtrend idea and continuing the overall directional move of the market to go all the way down. If that makes sense to you, drop me a 111 in the chat. Perfect, 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 perfect. Okay, cool. All right, awesome, awesome, awesome. So let me just delete this guy and hold up. Delete this guy. So now, because this is already on here, I'm gonna park right over here and explain, especially for our newer students, the 3 phases of the trend. Now, this is based off Dow theory. So Dow theory tells you that in general there are 3 phases to a trend: accumulation phase, public participation, excess phase for an uptrend, and then for the opposite, which would be your downtrend, distribution, public participation, and the panic phase. Different names for the same thing happening just in opposite directions. So what we're potentially seeing is that over here, right, we had phase 1, accumulation. Phase 1 is usually due or caused by banks / market makers. They manipulate. Manipulation is essentially what it is. This would be phase 1, right? And then I'll get into more specifics on a smaller time frame. So this would be technically, what is this? This would be technically your phase 1. Let's move you over here. Your phase 1, right? Then your phase 2. Phase 2 is your second impulse wave. roughly from here to here. And phase two is public participation. Which is where retail traders like you and I usually get in on the trades. Now, phase three, and these names are pretty like, if you think about it, they're pretty like self-explanatory. Like it kind of tells you like who's who and who's what or what's happening. So phase three is excess, meaning it's like what's left over of the move. Usually for phase three, we don't like to trade because it can be a lot of fake outs. It can be very short-lived, and a lot of people tend to lose on phase three. So this is for your uptrend, right? Now on a downtrend, let's find something further away from over here to make it easier to see. It's like up, 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 and then it's like down, down, down. I mean, technically, we'll do it on a smaller time frame. I don't want to get this too cluttered, but we'll do it on a smaller time frame if possible, or on a different pair. So now, why is this important? Because if we're seeing that price is approaching a resistance level, and it's also potentially meeting the downtrend, which is a second way of trading. You can trade off support and resistance. You can also trade off trend lines. And then you're seeing potentially the end of this sub-trend, this sub-uptrend. Those are three different ways of looking at the same chart, telling you it could be doing the same thing, which might tell you you might want to get in for a sell. So just in general, even if you trade HFX without indicators, if you just know basic market structure, you don't need indicators. Rather, if you don't know market structure, your indicators will fail you at some point, because indicators are created to help traders understand what is the chart saying. But the chart can tell you what it is telling you if you understand how to read it based off what you know from market structure. So now, excuse me. So now getting into, it's just different terminology about it. I don't use positive or negative. Positive is, in my opinion, is up, negative is going down. So I don't use a terminology. Terminology is subjective. You just want to pay attention to however you define or whatever words that you use, that it's, you know, it's in alignment with just the rules of trading. So now getting on the 1 hour, let's see, getting on the 1 hour, we're still seeing price is still going up. So our trade setup, we kind of established that on the 4 hour. Our trade setup isn't fully established on the 1 hour. So now one thing that I want to go back to right now is our trading zone. And this is going to be also very helpful for our HFX people. So getting into our trading zone, let me go ahead and delete this guy. And that's fine. Okay, let's see. So let me go back to the 4 hour. On the 4 hour, the most recent low, it's technically roughly right over here. It's technically roughly right over here, our most recent low. Now I'm gonna, for the purposes of this, class, I'm going to keep my daily, but I'm going to make it orange for the simple reason that it is no longer fully valid, meaning price broke through it. This is our new low. That it's still in the process of creating a new high. So technically, as of right now, this level isn't a valid support or resistance level because price definitely broke through it. It created a low that's lower than this level, and it's still yet to define a new high. So because of this, it broke through here. So technically our trading zone would be from here to here, because from where we're at in the chart, the next high that it could respect or could reject is this level, the next high. So as of now, our trading zone should be limited to here. Why is this important? Because getting into how we enter our trades, our entries of our trades. So, yep, going into the 1 hour, we don't have a new high yet. So technically, we don't have a new high. So this is still gonna limit our trading zone. Boom. Okay, great. So I'll get into our entry levels on this zone, and then I'll see if I can apply it to an actual market that we could potentially trade off for both HFX and FRX. So we have three main entries, or from how I know how to trade, which I trade harmonics, which I learned from Manny Quinones, is we have three main entries. Our first entry is called our E1. And our E1 is when you buy or sell at, it's not the pullback, I feel like Manny now, is when you buy or sell at the equal high or equal low, which is usually the limits of our zone. So for the purposes of here, I'm gonna, let me just see something really, really quickly. This is a better level. So our equal high and our equal low usually occur at the what I call the outer limits of our trading zone, which that looks like this, right? It came down here, boom, hung out, right? Came down here also, came here one time, second time, roughly returned to the same level, broke through a little bit, but our buy candle occurred right at the same support level of the outer limits of our trading zone, right? So our trading zone, whoa. So our trading zone establishes our different levels of entry. So where we were previously, why did I move this so far down? I feel like I deleted a level accidentally. I could be wrong. Oh no, it's here. It's just covered by the orange line. I'm not crazy. I was like, where's my level? So our first entry is at the equal high or equal low. So our lowest point for our trading zone would establish our first E1. So because it's been on the up and up and we bought a support, an E1, let me get an arrow. Over here, we could have caught a massive buyer's move, right? So your E1, and this is why defining your trading zone is so important, it establishes what your first type of entry would be, which is when it reaches the equal low, meaning the lowest external limits of our zone, or if you're looking for a sell, it would be the opposite. You would look for a sell opportunity at the highest extreme of your trading zone, right? Our second entry is the E2. So this is going to be E1 over here, E2 See, now this is why this daily became important, because what are we seeing over here, right? We're seeing the price came up, right? Small little baby pullback, came up again. Let me just lock this to make my life easier. Came down here, came up, came down. Now, because it seems that price respected roughly where our daily is, and I'm going to adjust it. Hold up. Going to adjust it. Oh my goodness. To roughly over here for the purposes of this. We are seeing how what seemed to be an invalidated support level actually on a smaller time frame looks like became a valid resistance level. So on a smaller time frame, we see what seemed to be an invalidated level served a purpose, because as we get into a smaller time frame, we're seeing more of the market structure and the market move. The reason that this is important is because this actually gives us our second entry. So where your E1 occurs at the equal low or the equal high, your E2 right over here. And let's change this color actually. I wonder if that work. Definitely not. That kind of works. So your E2 occurs when it breaks through the most recent previous high or the most recent previous low, meaning the most recent previous high in relation to this point is here, right? So your E2 is either the breakthrough or the breakaway entry, depending as to what you want to call it. It doesn't really matter. Is when it breaks through the most recent previous high slash low. So where this is your E1, right over here. Let's make this one red. Right over here. Then your E2, right over here. It breaks through the previous high and it continues the direction of the trend, which as of now, we're still on this sub uptrend, right? So that is your E2. E1, you buy or sell at the equal high or the equal low. Your E2 is the breakthrough or breakaway entry, depending as to how you want to call it, where it breaks through the previous most recent high or the most recent low, usually shown by a level of support or resistance, which we saw that this daily was really close to where it pulled back twice, and then it established that it continued the directional move by going up that we would have seen that is breaking through this level of resistance. We would enter, take a second position for a buy. Now, let's say for the sake of time, we're going to pretend we're on the 5 minute or the 1 minute. This very same structure, this very same of reading the chart for my HFX people will allow you to see that, this looks like what? It looks like it was consolidated, right? Consolidation, right? Now, if I was using simple scalper, right? Sell, buy, sell, buy. Now, market structure has a lot of theories. One of the main theories is that it says that if price returns to a level about 3 times, usually the third time could be a good move. If it goes back to, let's say, price stayed here, and then it came down here. If price hasn't done a very drastic move beforehand, then it may not be a good pair to trade that day. If it's staying consolidation for a while, that's just showing that there could be a lot of indecision in the market, or that market completed a very drastic directional move and it needs to rebalance itself. That's what consolidation is doing. The market is rebalancing itself. So going back to what I was originally saying, is that if you're seeing that price is consolidated the way it is over here, and let's say you're going for a buy, right? You're going for a buy, you clear, and then you're expecting it to sell off. And then how many of us have been using Simple Scalper? We see price reaches the top red band, we go in for a sell, price isn't dropping, it keeps going up. That is telling you that the direction has continued in a specific direction. It is no longer consolidated. So if you're seeing that price is breaking through, this is why you want to pay attention to your candles. Then instead of getting in for a sell, you might want to take it in for a buy. So even in HFX, if you're trading off the 5 minute or the 1 minute, which if you're trading off the 1 minute chart, you want to trade off your at least 5 minute support and resistance levels, that if it breaks through this level, you may want to go in for a buy instead of a sell. Because what this is telling you is that there's a second entry to catch the up move that is happening versus the sell move that you may have thought was going to happen. So you want to make sure you pay attention, not just to your levels, but also to the candles. And I wasn't going to get into it on this session, but if you're looking at these candles, and I trade off Heikin-Ashi candles, if you're seeing these full-bodied candles, full-bodied candles, that is telling you that the market is strong for the buyer's side. And you're seeing these big full-bodied green candles, and there's no wicks on the bottom, and prices is going up. That is telling you that the buyers are very, very strong in the market, right? The minute you start seeing smaller candles and a lot of wicks from both sides, that means there's a little bit of a tug of war situation happening. Then you're seeing these candle bodies are getting smaller and smaller and smaller. Momentum is going down. You may want to avoid trading, because what's happening is we're also approaching a sub level of consolidation, whereas like you don't really know exactly what's happening. We're seeing wicks on both sides. You could get spiked out, you could get stopped out. So you don't want to really trade when the market is super consolidated the way it is over here, where there's almost no range. Unlike over here, there's definitely range for the market to go up and for the market to go down, right? Now, our third type of entry, we'll use this level, right? Is technically, this would be this would be like an E1 situation over here, roughly, right? You see, it's not really an E2. Trying to find a nice textbook example. Let me see something real quick. That works. So your third entry, right, is the break and the retest. So the break and the retest occurs where price goes up like it does over here, and then it comes down to that same level. Let me just do a fresh markup. What's happening with my mouse today? Right, it's gonna do a fresh markup, right? It goes up, then it goes down, and then what happens? It continues the direction of the move, right? Now, when it does this, the break and the retest is it breaks through again. It's not just breaking through anything. It is breaking through a level of support or resistance. So what was previously support over here became support again, right? It was resistance for a hot second, pulled back just a smidget, came up, came down, came up, came down, right? So the break and the retest is when price breaks through, right over here, breaks through this level, then it goes back to that very same level, and then it continues the overall direction of the move. So technically, this would be your E3. So your E3, break and retest. It almost feels like it's a game of ping pong, where it goes up, it goes down, it goes up, and then it goes down, and it completely shoots to the moon if it is a buy trade. So E3, it breaks and returns. So basically it returns to the previous level, broke through to continue the directional move of the market, right? So now, and then we're gonna wrap up in about 5-10 minutes because I wanna get into the homework before we break. So now, a few things about trends and movement. And we touched on this last week with Millie about trends and consolidation, right? So let me find something that isn't so busy. Let me see. I'm gonna delete this. What's that? Okay. What's happening? Let's see. 1, 2, boom, boom. All right. Perfect. That's perfect. So now I'll get into this really, really quickly. So now here we have a few things, right? Here we have a few things that I'm gonna quickly explain. So from 0 to 1, this is called your impulse wave. The impulse wave is the wave that follows the direction of the trend, right? So we have 3 impulse waves. Right? We have 3 impulse waves. From 4 to 5 is our third impulse wave, right? Third impulse wave. Now, the impulse wave is also expansion impulse wave. Right? So we have 3 impulse waves. Then, opposite to the impulse wave, so from 1 to 2, we have your pullback or your contraction. consistent. So from 1 to 2, pullback or contraction. Now there's literally so many theories on waves, Elliott waves, that you could literally just study impulse waves and Elliott waves for like years. And that was actually the first thing that ever made sense to me when I started studying was literally Elliott waves. So I bring this up because everything goes hand in hand. Even here, we have 3 phases of a downtrend, right? Distribution, public participation, panic phase. Distribution, which is phase 1, right? Phase 2, public participation. I'm going to do just the initial since it's a little tight, right? Then phase 3, panic. The reason that this is important is because let's say, for whatever reason, all we know is that let's just say price is right over here. We don't even know where it's at. Let's say we haven't seen anything, and actually, hopefully this works. Because last time it wasn't working for me. Oh, I don't know why it's not available. See, anyways, but let's say hypothetically speaking, all we see is this right now. But we know we saw the first move, second wave. We're kind of currently in this pullback. We don't know if it's going to keep going up, if it's going to keep going down. But what do we know just even about marking up our levels, right? You're like, I'm on the 4-hour. What if I find a smaller resistance level? And then let me just zoom in, see if I can find a better level. It's like, you know what? Pep said, if I can find maybe a more clear point where price is a stronger reaction, I might make this my level. Maybe I'll add a few levels in case I'm a little confused as to how to properly mark up my charts. That traders also add additional levels, even though they may not be the strongest levels where price has reactions. And this, going back to what I mentioned earlier, could be a trading zone. It could be a resistance zone. That if you were to mark up your levels, right? And let's say all we know is here, and then we're seeing that price is approaching very closely to the bottom of this resistance level, it is very possible there could be a strong reaction to the market. Now, let's say that if you know that there's 3 phases to a downtrend, price is near what could be a potential resistance level, then we're seeing price is doing kind of like this little ping pong effect. It's going up, it's going down, it's going up, it's going down, it's pulling up again, doesn't really hit it. It's kind of close to my other level that I marked up earlier. I might want to take this in for a sell because realistically, even though it pulled back over here, right, it continued to drop, came up. We have what we would have on E3, boom, take in another position right over here, and then you can get in for a sell and write out the rest of the trend move. So with that said, that is going to conclude all the info that I wanted to discuss tonight. So the homework, and it is going to be due Saturday, 2 p.m. PST time, 5 p.m. Eastern. So homework due Saturday, 2 p.m. PST, 5 p.m. Eastern. If it's late, I will not be reviewing it. It is what it is. So if you want feedback on your charts, please make sure to hand in your homework by the deadline. Your homework is to do two markups, 2 chart markups with the 3 phases of both trends, meaning up and down, your 3 different entries, they may not necessarily be found where you mark up your trends, right? And within the 3 phases of both trends, please include labels for the waves. So impulse, pullback, impulse, expansion, pullback, contraction. This is a typo. So 1, 2. So this is the homework for tonight's session. Next week will be our last session. I am, knocking on wood, waiting on confirmation for my guest educator for next week. So I strongly advise that you do this homework so that we can again reference it and so that we can also give you feedback on your homework. But on that note, I'm gonna go ahead and end this session. Enjoy the rest of your evenings. I will talk to you guys soon, and I will see you guys on the charts getting the bag. All right, guys, enjoy the rest of your evening, and I'll talk to you guys later. Bye, guys.